Hey friends, today we're diving into some juicy news about Singapore banks. You might think all banks are created equal, but JPMorgan's latest report suggests otherwise. They're shaking things up with their take on DBS, UOB, and the wider banking landscape. Stick around, because I'm about to break down why this matters for your investment strategy and what it means for the Singapore economy. But first, let me give you a quick intro. I'm Iggy from the Investing Iguana, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I produced over 700 videos with more than 300,000 watch hours as of December 2024. I also focus on regional and world economy topics. Now let's dive into the meat of this report. JPMorgan's got some interesting predictions about factor rotation and how it's going to affect banks in Singapore, Indonesia, and Thailand. But what does this mean for you and me? Let's break it down. First up, let's talk about the big picture. JPMorgan's seeing some shifts in the US dollar and growth differences between the US and the rest of the world. Think of it like a game of financial musical chairs. When the music stops, some banks might be left without a seat. For Singapore banks, JPMorgan's saying they might be trading in a range for the next 6 to 12 months. What does that mean? Well, imagine your favorite stock is like a yo-yo. It goes up and down but stays within a certain range. That's what they're predicting for Singapore banks. But here's where it gets interesting. JPMorgan's suggesting that Singapore banks might become a funding source on a rally. In simple terms, if there's a market rally, investors might sell their Singapore bank stocks to fund investments elsewhere. It's like using your piggy bank to buy something shiny. You're not necessarily giving up on the piggy bank, but you see better opportunities elsewhere. Now let's zoom in on specific banks. DBS is getting a thumbs up from JPMorgan. They're preferring DBS over other Singapore banks. Why? Well, they haven't spelled it out in this report, but typically, factors like strong financial performance, good management, or strategic positioning can make a bank stand out. On the flip side, UOB's been downgraded to neutral. It's like going from being the star player to sitting on the bench. Not terrible, but not great either. This downgrade suggests JPMorgan sees less upside potential for UOB compared to its peers. But wait, there's more. JPMorgan's also got some thoughts on banks in other Southeast Asian countries. They're warning that Indonesian banks might face some tough times if liquidity remains tight. Think of liquidity like the oil in a car engine. If it's low, things don't run as smoothly. Thai banks, however, are expected to be the dark horse in this race. JPMorgan predicts they'll outperform thanks to lower non-performing loan NPL formation, and higher payouts. It's like Thai banks are expected to have fewer bad debts and give more back to shareholders. A win-win situation. Now, let's get into some nitty-gritty details about Singapore. JPMorgan points out that the 3-month SORA, Singapore overnight rate average, has dropped by 100 basis points in the last 6 months. That's a significant move. To put it in perspective, it's like the price of your favorite snack dropping by $1. Noticeable and impactful. But why does this matter? Well, SORA is a key interest rate benchmark in Singapore. When it drops, it generally means lower borrowing costs for businesses and individuals. This could potentially stimulate economic activity, but it also means banks might earn less from their loans. JPMorgan also mentions that the Monetary Authority of Singapore, MAS, targets the Nominal Effective Exchange Rate, NEER. Think of NEER as a way to measure the strength of the Singapore dollar against a basket of other currencies. By targeting NEER, MAS is trying to balance Singapore's economic needs with its currency's value. Here's where it gets interesting. JPMorgan suggests that if the Singapore dollar depreciates, it could accelerate the trend of falling interest rates. It's like a domino effect. One piece falls and it triggers a chain reaction. So, what does all this mean for you as an investor or someone interested in the Singapore economy? Well, it's a mixed bag. On one hand, lower interest rates could mean cheaper loans, which is great if you're looking to borrow. On the other hand, if you're saving money in the bank, you might earn less interest. For investors in bank stocks, it's a reminder that not all banks are created equal. DBS seems to be JPMorgan's top pick among Singapore banks, while UOB might need to step up its game. And if you're looking at the broader Southeast Asian banking sector, Thai banks might be worth keeping an eye on. Remember, though, that this is just one analyst's view. It's always important to do your own research and consider multiple perspectives before making any investment decisions. Before we wrap up, I want to remind you that if you're feeling overwhelmed by all this financial jargon, don't worry. I've got a free guide on understanding bank stocks that breaks down key metrics and terms. You can find the link in the description below. To sum it all up, JPMorgan's report gives us a snapshot of the banking landscape in Singapore and Southeast Asia. They're bullish on DBS, cautious on UOB, and see potential in Thai banks. The broader economic factors, like interest rates and currency movements, are also playing a crucial role in shaping this outlook. What do you think about these predictions? Do you agree with JPMorgan's take on Singapore banks? Drop your thoughts in the comments below. I'd love to hear your perspective. Thanks for watching, and remember, stay curious, stay informed, and keep growing your wealth.